What's good? Kurt Trades here again. This is the second episode in the series, and today we're going to be going over liquidity and the easiest way to identify liquidity, how to trade it, how to identify on the charts, and basically the logic and understanding behind why the markets move using liquidity. So let's get into it. So first of all, we need to understand liquidity. So this is, in my opinion, one of the most important concepts you'll ever learn when it comes to trading, because liquidity is what actually fuels the marketplace. Liquidity is what makes the market move. So it's important for us to understand that on a deeper level. So markets are driven by liquidity. In order for the big players, e.g. banks, institutions and hedge funds, these are the people that control the market. We do not control the market. So the guys that actually control the market, the big guys, for them to fill their positions, they have to push price to levels in price that are highly liquid. So the easiest way I can explain it to you is, think of a slingshot, right? If you wanted to reach a specific target, you would want to pull it back a decent amount to get the power on the shot to get to the target, right? And the same is true with liquidity. So the big players, they'll pull price back to areas that are highly liquid, like old highs and lows to the left of price and imbalances in the market, so they can fill their large orders and positions to then propel price forward in their chosen direction. Okay, so it's important for you to understand that. So basically, in short, the market moves for two reasons, and it's as simple as we need to keep it. The market moves to take liquidity from old highs and lows to the left and to fill imbalances in the market. That's it. And by using these models that I'm going to teach you in the next couple of slides, you'll constantly be trading with these key things in mind, which is why the market moves. So you'll always be trading from liquidity pool to liquidity pool. Okay, and means basically more often than not, you're going to be on the right side of the market. So universal models. First of all, universal meaning that price is fractal. So these can be applied to any time frame. However, as I said in the previous video, we want to stick to our higher time frames for our overall bias, as we're then trading with bigger moves in the market. So I use these models on the weekly, the daily and the 4 hour, and there's 3 universal models that we can identify which will allow us to be trading with liquidity at all times. So you've got internal range liquidity to external range liquidity, i.e. trading from internal targeting external. This is also coined as IRL to ERL. We've got external range liquidity to internal range liquidity, which is ERL to IRL. And then we've got external range liquidity to external range liquidity, ERL to ERL. So I'm going to go through these in more detail now so you know exactly what they look like. So first of all, we've got internal range liquidity to external range liquidity. So when we see this in the market, we can see we've had a low formed, we've expanded away, we've created a temporary high in the market. Okay, so we've got this bullish leg in price. We can see we've created a gap between this wick and this wick. We've got a gap here. And so when we see this in the market, we're basically waiting for price to retrace down into this gap, wait for our confirmation here. This is where we'll be looking to take an entry, and we'll be looking to target this high. So this is what it would look like before it's actually happened, and this is what we'd basically be looking for after it's happened. So at this point in time, this is where we'd be interested, because now we've had a low expansion away to create a high. We've pulled back into our internal range liquidity, which is this imbalance and fair value gap in the market. We've then created our swing point, which you learned in the previous video. So we know a swing point is in. We're potentially now looking to trade away from this swing point and target the external range liquidity. Okay, so we're basically trading from internal liquidity to external liquidity, which is an old high. That's the first model. The second is external to internal range liquidity. So if we look here, price has expanded into an old high from the left, which is our external range liquidity. We've then had our candle 2 closure. Our eyes should automatically come into here, because we can see we've got a gap in price that's more than likely going to want to at least tag here before it either continues, or it might just consolidate and then we see what happens next. But once we identify this on the chart, on the 4 hour, the daily or the weekly, we've got a pretty good idea that price is at least likely to trade into this low here because this is obviously the internal range liquidity. So we've expanded into an old high from the left, we've taken liquidity from here, we've then had our swing point form. Where's the next thing we want to see? We want to see if we can trade down into internal range liquidity. So this will be where we're looking to enter, and this is where we'll be looking to target and exit the market. So obviously this is before, this is the after. You can see we take the external, we trade higher, we get our swing point form, and then we then trade expansion lower in candle 3 into our internal range liquidity. So that's the second model. And the final model is external range to external range. This is where we don't have any fair value gaps or imbalances in the market. Price is making highs, it's making lows, it's just sort of consolidating and ranging. And basically we want to see either the range high swept and trade to the range low, or the range low swept and then trade to the range high. So this is what we'll be seeing in the market beforehand. Yet again, for the best ranges to play with, you want to be looking for these on a higher time frame. So what happens here, you can see prices just consolidating. We trade up into the external range high, which is where we're looking for price to reverse and get on side. We wait for our candle 2 closure, which you can see here, and then we look to trade candle 3 expansion into the range low. So by being able to identify and understand these models, you are always trading with liquidity in mind, which is what fuels the marketplace, which means you're going to have a better success with your trades, and you're basically using the foundations of why the market moves in the first place. So you're trading with liquidity, and your market moves that you get in, so your trades are fueled by liquidity, which means they're probably going to be a lot more expansive in your direction too. So when you're trading candle 3s like this, and you're having a candle 2 at a key level or a liquidity pool, your candle 3 that you're trading is usually going to be quick and expand into your targets, which is exactly what you want to see. You don't want to be getting into trades where, you know, you enter a position and you're just chopping around for ages. You don't want to see that. You want to basically be getting into positions where you get in, you've had your liquidity sweep, you're in your trade, and then it just expands to your target relatively quickly, okay? So universal model logic, which is what we've just went over. So understanding the logic behind these models. By identifying these models on the chart, we're automatically trading from liquidity pool to liquidity call. So remember, price moves for 2 reasons: to sweep liquidity from old highs and lows to the left, and to fill imbalances in the market. So by using these models, it gives us clear structure and framework to follow when we're on the charts. We look for these models, we know we're then trading with liquidity, and we use the concepts that I taught you in the first lesson to obviously have more high probability and understanding behind what's going on the charts. But by following these models, like I said a second ago, and waiting for those C2 closures on our higher time frame, the next phase of price is usually expansion, which means you're getting in at a good time in the market, and you should hit TP relatively quickly within that same day or same couple of hours. And so basically, if you can't identify any of those universal models that we've just been through, so external to external, external to internal, or internal to external, then realistically speaking, there's no trade, and you shouldn't be looking at that market, because you're not trading anything, in my opinion, that's high probability. You want to wait for these universal models to form on the higher time frame, and once you can put context behind them using the narrative that I taught you in lesson 1, your trades will have a much higher success. And like I said, you don't need loads and loads of trades, couple trades a week, and you're golden. People underestimate the power of mental capacity when it comes to trading. The less decisions you have to make, the better that you'll perform. If you're trying to take, 5-10 trades a day, you're diminishing your mental capacity to make good decisions. And this is another reason why you want to obviously trade kill zones and stuff. So just to clarify one more thing before we go on to some examples, key liquidity pools. We know obviously, as I said, that the market moves to highs and lows, but that doesn't mean we want to pay attention to every high and low in the market. We want to focus on the following, as it gives us structure whilst trading the highest probability sequences. So we're only interested in session highs and lows, which is basically congruent with the 4-hour time frame, and then daily highs and lows, and weekly and monthly highs and lows. These are only highs and lows we're interested in. We don't want to be looking at 15-minute highs and lows, 5-minute, 1 hour, because then you're just trying to trade every single high and low that's present in the market. We want to be having structure with our trading and trading the highest probability sequences, as I said. So I'm going to go over a few examples with you guys now in terms of what I basically look for in the charts, and I haven't picked out any examples because I just want to show you how this is present every single week on all assets on our time frame. So I'm just going to go through and just pick some of these out, and you can obviously see them at play. So if I show you right here, this is a trade I took earlier on in the week. We've got a low, we've got a high. Price is then just basically ranging. See how there's not really any gaps here? Price is very range bound. I'm gonna pick one from each class, asset class. So this would be external to external, right? So notice how I've got a low, we've got a high, and then we're just in between that. This is the daily time frame, by the way. So we're not really doing anything, we're just ranging around. What happens after we get our candle 2 closure and run the highs? We expand lower. We've got this low here, which we're now trading into. Obviously this is last week, so this is Friday this week. So it's more than likely we're now going to expand into these lows probably on Monday or Tuesday next week, I should imagine. But I just want you to pay attention to the model. This is external to external. We've got a low, we've got a high. There's no real gaps in the market. It's just sort of ranging around. Price moves up into this high. Oh, don't want to do that. Hopefully that doesn't load up. So we've then got this high here. We sweep the liquidity. We have a candle 2 closure, and then we start trading lower to take out the lows. This is going to be the next target, more than likely. So there's trading from liquidity pool to liquidity pool. It's an old low from the left. We're trading from an old high from the left to an old low from the left. So this is a daily time frame, by the way. So you could trade and hold that all the way down to these lows and these lows. If you wanted to swing trade, you can do that. Let's go on to GU and have a look what we've got going on here. Trading from this range high. This an old high from the left. We don't have a candle 2 closure though, so it's not valid. Well, it could be valid, but it's not something that I would personally trade. I'd want to see this taken and then a candle 2 closure, so that's not something that I'd personally be interested in. However, if you look here, if I pull price back, what have we got here? Even again, we've got a low, we've got a high, price pulls back, candle 2 closure, we've got this gap here, look. This is how you start to build this narrative. We've got a candle 2 closure, sweeping this liquidity into our internal range liquidity because we've got a gap here. So once we see our candle 2 closure at our internal range liquidity, we should then be looking to the left and seeing, okay, what have we got that we can potentially target? Well, we've got this high here, haven't we? Price is expanding, we're in an uptrend, we're creating gaps. We've then obviously hit this gap here again, created a candle 2 closure just here. And then what do we expect after candle 2 closure? Well, usually it's expansion again. Obviously this one falls a little bit short. Obviously you don't have to hold it to these targets. This is a daily time frame, so this here alone is 130 pips. So for me personally, I'd only be looking for a 1 to 3 because I don't be greedy. Because obviously the longer you hold positions, you have to undergo retracement, a new phase of price, but you can see the model at work again, you know? So there's that. Let's go to NZD USD, just play current price. Here again, what is this? What have you got here? So look at this here. We've got an old high from the left. What do we get? Price runs the high. we get a candle 2 closure, so we've taken external range liquidity here. So then we should look back within this price and go, okay, we've taken external range liquidity. Realistically speaking, once we've taken external range liquidity, what should we be looking for at the very least? Internal range liquidity. So what have we got here? Got a gap in price. Price runs these highs, equal highs. This is another form of engineered liquidity, equal highs. We sweep the equal highs. We get a candle 2 closure here. We've got an internal range liquidity to fill. If this internal range liquidity fails to hold, i.e. we don't get a candle 2 closure and start reversing away from it, it's very likely that we're then going to target this low here. So notice how we expand up. We've created all these equal highs because these highs are equal. This high here is equal to these highs. So there's a lot of liquidity resting above these old highs to the left. Price runs and sweeps out those highs. We get a nice candle 2 closure on the daily time frame here. So immediately when I see this model, I'm looking in current price, where could we potentially target? Well, I've got internal range liquidity here. So that for me would be the first target. Obviously you can see here what happens on the next day. We expand lower into this gap. Now we've closed below this gap. We've failed for this fair value gap to hold. Very highly likely that early on next week, we're probably going to come run all these equal lows. Notice how all these lows are very equal. See that? And obviously we've got a gap there as well. So chances are we're then probably going to target it. So this is an example of external to internal. And yeah, you can see this, it literally happens all the time. What have we got here? Potential range play. So these are all recent price action. This is Tuesday this week. These models are present on all time frames. They happen every single week, and that's why when you understand the market to this level of detail, you can just pick the best plays that have the most range every single week. And that's why I trade multiple pairs. I've got about 20 pairs I trade. When you understand these models, it becomes easy to identify. You just flick through your watch list, you see which models are present, you identify the most high probable ones using SMT, which I'm going to teach at some point later in this series. And then once you see them, you basically just wait for your intraday price action to confirm your higher time frame. You get on side and you let price do its thing. This is how simple trading can be. So if I look at this here, see price in this time period, it's not really doing anything. You know, we're not expanding anywhere. We're just sort of chopping around, not really doing a great deal. And then what happens? We run all of these highs here. See these highs. We run it out. We get our candle 2 closure, and then we start to trade lower. So this is external range liquidity trade into external range liquidity. So if I zoom in here, just to annotate some bits. So you basically got prices consolidating, we're ranging, we're not really doing anything. We run that high here. We get our candle 2 closure because we failed to get a body close above this. And then we're looking to trade into the external range low, which you can see we take there. Like I said, these models happen every single week, and this is the easiest way to trade liquidity. Let's have a look at USD CHF. So this is one I actually looked into last week, I believe, on USD CAD. Yeah, this is using some SMT stuff. I won't go into that now. But when you basically get SMT like this with a correlated asset, you can treat this as a candle 2 as well. But I'm not going to go into that today. So let's just see what else we've got here. To be honest, there's nothing really too clean in here. There was a candle 2 closure in here, and this is why I'd use SMT with this. Basically what you've got here, this is a little bit more advanced stuff, but you've basically got a high and a low here. This low is formed from a gap to the left. So this is technically, potentially, an internal to external move here. So you basically got your low, your high, internal range liquidity. Notice how we failed to close below this gap. So this gap is holding, we're rejecting the 50% of this gap, and then this internal range here fails to hold. Notice that? So this would potentially be an internal to external move at this low. However, you're trading against another model over here. So this is getting into a little bit more advanced stuff. And the reason I looked at taking this trade long, I can't remember if I caught it or not, but I definitely had this marked up. If you look here, we've failed to close below this. So this gap has held price. This gap has then failed. So we've closed above this gap. So the chances of this now selling off are lower probability. We then look to the left, we've got all these stacked highs. This is a form of engineered liquidity known as trendline liquidity. So notice how we've got all that there. When we've got all these stacked highs to the left, we know there's lots of liquidity resting above old highs and lows to the left of price. We've got a potential internal to external move. And we've then had our candle 2 closure here after failing to reverse and go lower from this. So this is where you start using things like SMT, and you can potentially expect expansion in candle 3 to take out all these highs. So that's a little bit more advanced, but once you start to understand and reprice, you can start to pick up on these little things. If I go here as well, I'll just show you some SMT stuff quickly. So when you basically have cracks in correlation, I'm going off a little bit of a tangent here, but just to show you what I meant. Notice this low here, right? This low here on the 2nd of July. So this is USD CHF, a correlated asset is USD CAD. Notice how here on the 2nd of July, we're taking this low out, right? Whereas on USD CHF, we're not taking this low out. There's your first stage crack in correlation, right? This is showing strength because this is failing to take the low, whereas USD CAD is taking that low, right? There's your first stage crack in correlation. Your second stage crack in correlation is between the closes. So notice how this Friday candle closes bullish, whereas USD CAD closes bearish. This is now a 2-stage crack in correlation, which confirms this is highly probable as a reversal. And this is how I was basically happy to take this trade higher into all these highs. So going off a little bit of a tangent there, but just to show you some of the SMT stuff and how you can pair that with the higher time frame universal models to get on side with price. I'm going to do a couple more here and then we're going to call it a day. So straight away, what do we see here? All this trend line liquidity that we've taken out. All of this liquidity here. We've also come into this gap. So you've got internal range liquidity potentially, but also what have you got right here? You've got internal range liquidity here. So you've swept all these engineered liquidity. Look how these lows are all formed. This is how you know this is just asking to get taken. All these lows, none of them are getting taken out. This one does a little bit here, but look at all these lows here. This is just trend line liquidity that's just asking to get taken. And this is going into a little bit more advanced stuff again, but when you've got trend line liquidity and below that trend, you've got internal range imbalance to fill in the market, these signatures in price, they basically just tank. So going off a little bit topic there, but these are some more advanced stuff. But let's just keep it basic. What have we got here? We've taken out all this liquidity and then we've potentially got external to internal in this gap. So what happens? You've got candle 1, candle 2, candle 3. This closes a candle 2 closure. So what can we potentially expect? Expansion in candle 3 into our internal range liquidity. So hopefully that makes sense. I didn't have any examples picked out just purely because I wanted to show you guys how these models repeat every single week, and they're very easy to identify. You just need to be able to train your eye to see them, and once you start seeing that and you learn about SMT and precision swing points and all these things that make a trade scenario high probability because you're using SMT and cracks and correlation, your trading starts to become not only simple but the sequences that you trade are very high probability. So hopefully that helps, guys. Any questions, as always, hit me up, and subscribe to the channel if you're not. A lot of you guys who have been watching this stuff are not subscribed. So yeah, hope you enjoyed, got some value from it, and any questions, hit me up in the DMs. Best place is Instagram. Peace and love, gang.